Hi there, and welcome to Mastering the Markets, your path to financial freedom. This step-by-step guide will help you with understanding the stock market and the fundamentals of options trading. I'm Sophie B., an options trader and coach, and I've been navigating the market since 2018. But before I jumped into the world of trading, I served in the military for 6 years and I did 2 combat tours to Afghanistan. If you're new to trading or if you've tried it before but you found it overwhelming, then you're in the right place. This course is designed to take you from the absolute basics of how the stock market works to understanding the power of options trading. We're going to break down everything step by step. I'm not going to use any confusion jargon, and I'm just going to give you real strategies that you can apply. First, we'll cover the fundamentals, like what is the stock market? How do stocks move? And why do investors and traders use options in the first place? Then we'll dive into the exciting world of options. You'll learn what calls and puts are, how they work, and how you can use them to make money, whether the market is going up, down, and even sideways. Most importantly, we're going to talk about risk management because trading isn't just about making money, it's also about protecting your capital and making smart and strategic moves. So by the end of this course, you're going to have a solid foundation to start trading with confidence. Whether you're looking for an extra stream of income, a way to grow your wealth, or just to learn a new skill, options trading can be a game changer. So I'm excited to have you on this journey with me. Let's dive in and start mastering the markets. And keep in mind that this training is for educational purposes only. And whenever you do decide to trade, there's always a risk involved. So first, we're going to get into just the basics of the stock market. So the stock market is where companies and investors come together to buy and sell shares of ownership in businesses. Let me break it down. When a company wants to raise money to grow, it sells shares to the public through an IPO, an initial public offering. Once these shares hit the market, investors like me and you, we buy and sell them on stock market exchanges like the New York Stock Exchange, the American Exchange, or the NASDAQ. Now, aside from the major stock exchanges like the New York Stock Exchange and the NASDAQ, you also have what's called over-the-counter bulletin board, or OTC for short. This is where you're going to find your penny stocks. And penny stocks are low price stocks that trade outside of those big exchanges. You want to be careful with penny stocks because many of these stocks are highly volatile and they're often targets of pump and dump schemes. A pump and dump scheme is when a stock price is artificially inflated, typically by hype. And then insiders sell their shares, leaving regular traders with major losses. So you don't want to get caught holding a bag with a pump and dump scheme, or you're not gonna have a bag. So we're not gonna trade pennies. We're not making pennies. We're not touching penny stocks, okay? So the stock prices go up and down based on supply and demand. So if more people want to buy a stock, the price goes up. If more people want to sell the stock, then the price drops. Factors like company earnings, news, and even emotions can drive the market. Some investors hold stocks. Some people like buy stocks and hold them long term, like 10, 20, 30 years, betting on a company's growth, while others like traders, they tend to buy and sell stocks more frequently, trying to make a profit from short-term price movements. So when you start trading, you want to decide whether or not you're going to be an investor or a trader. Again, the traders, we sell short term to get and capitalize our price momentum, while investors, they buy and hold it for the long term. So understanding the stock market is the first step to building wealth. But once you get the basics down, you can take it further. Okay, so not all stocks are the same. The stock market is divided into sectors, and these sectors are groups of companies that operate in the same industry. There are 11 major sectors like technology, healthcare, and finance. And within each sector, there's what's called subsectors. Like technology, for example, it includes software companies, semiconductor makers, and hardware manufacturers. Where in healthcare, you got your pharmaceuticals, biotech, and medical devices. Understanding sectors will help you diversify your port. Understanding sectors will help you diversify your portfolio and spot different trends. When people talk about the market, they're typically referring to indexes like the S&P 500, the Dow Jones, or the NASDAQ composite. And indexes track a group of stocks to show how a section of the market is performing. Now, instead of buying individual stocks, you can also invest in ETFs, exchange traded funds. ETFs are like a basket of stocks that track an index. And so it essentially gives you instant diversification in a single trade. So think of it like Easter eggs. The individual stocks are Easter eggs, and they're in the index, the Easter egg basket. That's just a good way to understand indexes. So again, this is just time sensitive information. Typically, like I said, the news can drive the market and also the position of the stock, whether it is near a support and resistance lines. So support and resistance are key levels on the price chart. A support level is the price where the stock tends to stop falling because buyers step in. And resistance is the level where the price struggles to break through because sellers are taking their profit. So traders use these levels to plan entry and exit points. So if something break above resistance, it could keep running. And if something drops below support, it may fall further. I placed this example up here on the screen just to kind of show you, and I just put just one set of support and resistance lines. You can draw more support and resistance lines, but I just wanted to show you how the news or how the market can react off of the news. So this is as of this recording, recently the president announced that there's going to be tariffs, and this injected a lot of volatility into the market. And so right here, I have an example of the S&P 500 ETF, SPY, and that is, it's represented by the ticker symbol SPY. So SPY experienced a 10% correction from the highs, just about concerns of economic growth and inflation. And if you notice, so this is when the election happened, and this was the price of the stock. So essentially, the stock found its way back to a safe place before the election. And the key support was found around 550, and key resistance has been found around 570. And again, this is as of the training, as we continue to wait for the president to announce what those tariffs actually are. So the reason you want to keep the support and resistance in mind is because you can see how when the price kind of hits the resistance, it bounces back down, came here. I don't know what happened right here. But the main point that I wanted to point out was how the stock reacted and found support right here. And it found resistance right here. And the resistance correlates directly to the election, and the price is moving pre-election. So this is just an example of how stocks can move from the news. Now with stocks, you have what's called a spread price. And the spread is the difference between the bid and the ask price. The bid is what buyers are willing to pay, and the ask price is what sellers want. So when you're purchasing a stock, you're going to buy it at the asking price. You're going to sell it at the bid, okay? The tighter the spread, the more liquid the stock. A wide spread, that means less liquidity and higher trading costs. So if you're trading options or low volume stocks, always check the spread because it can impact your profits. Now, this is just a couple terms that you will hear while trading. Bullish, that just essentially means that, the market's going up. You have bearish, that means that the market may go down. You can open a trade. You have two options to open a trade. You can buy to open, or you can sell to open. If you buy to open, you have to sell to close that trade. Okay. If you sell to open, you have to buy to close. Now, I know you're wondering, how can I sell to open? You can sell an option contract that you do not own, make money while whichever with you could sell either, you can make money, and typically this happens when you think the stock is going to go down and then you buy to close, typically at a cheaper price than what you sold it to open. Next, we have filled. That's essentially when you place a trade, you'll see that it will say like your order was filled at this price. That's all that means. Long as when you actually buy the stock or the option, and then short is when you borrow. So shorting is essentially the sell to open. Next, you have order types. You have a market order and a limit order. Now, I put up here, do not use a market order to enter a trade. I would say the only reason I say this is because if the market is moving fast, you may end up paying more for a trade than what you initially thought you were going to pay. So think about market price and limit price as like maybe, I guess, like a house. So let's say someone is selling their house for $300,000. You just buy that house for 300,000, right? That's market. That's a market order. A limit order is, hey, I only want to pay 290 for this house. So I'm going to set my limit at 290. So when the price of this house come down to 290, then I'm going to buy it. That's kind of how a limit order works. And you would use that limit order basically to negotiate the price that you want to pay for the stock or the option. And once the price reaches that limit, it will enter you into the trade. Next, you have a day order. A day order essentially says like, get me into this trade today. If my trade is not executed today, it will cancel out and it will not like get executed tomorrow. On the other hand, you have a good till cancel. This type of order, it's basically good until you cancel it. So let's say the stock doesn't reach this price today or the option doesn't reach this price today. It's good until it cancels. And then it really just depends on the broker. The order can stay like 60 to 90 days. Then when exiting a trade, you have what's called a stop loss. So this is how we're going to protect it's like risk management, a protective order. When a stock is going up, you want to set your threshold or, when you enter a trade, you want to know how much, like, what's your stopping point? What's your exit point, right? So that's what the stop loss essentially is. It tells you, like, hey, if I get into this trade and it goes down 10%, get me out of this trade. Next, you have a stop limit. Now, a stop limit, so some brokers allow you to put in a dollar amount, and some brokers allow you to put in a percentage. So that stop limit, let's say you put in your stop limit at if my stock or option contract goes down 50 cents, get me out of this trade, right? If it has to touch that specific price, if it does not touch that specific price, it will not get you out of that trade. So that's why I say do not use a stop limit to get out, because if it jumps the price, you're going to be in a trade and you're going to be losing, and you don't want to get caught in that position. Next, we're going to discuss ROI, or return on investment. It essentially measures how much money you've made or lost compared to what you've invested. It's calculated as profit divided by initial investment times 100. In this example, we invested $1,000. We made a profit of $200. So that gives us an ROI of 20%. So a high ROI means a strong return, but don't just chase big percentages because it's a bigger risk. Like it's a bigger risk. So trade smart. And trading is about consistent, balanced growth. Okay. And also, let's not get caught up too much on a dollar amount and focus on the actual percentage of returns. My rule of thumb is 20%. If you're up 20% and that momentum starts to slow down, exit your trade. Take your 20%. You want a constant 20% return over chasing like 100% or 200%, because sometimes options can bring those returns. If you have a runner and you have a stock that has high momentum, high volume, let it run. But as soon as that momentum slows down, exit your trade, take your returns. especially if you're already up more than 20%. Next, we're going to discuss fundamental analysis. Now, we're here to be options traders. So, as far as options trading, the main fundamental analysis you need to do is knowing where the 52-week high and low is located. So, this is essentially the price that the stock has traded the highest in the past year and the lowest in the past year. The reason these points are important because if the stock is trading near a 52-week low, that means it could use that 52-week low as a support line and bounce back. If the stock is trading near a 52-week high, then the stock may use that 52-week high as resistance and pullback, and pull back. Next, we have market cap, and basically this just determines like the market value of the company. The reason you need to know about the market cap as an options trader, because we don't want to trade any micro or small caps. Again, this kind of goes with those penny stocks. We're not chasing pennies over here. We're not doing anything micro. We're not doing anything small. We're hanging with the big boys. Okay. So, most importantly, you need certain tools to be a great trader. A cell phone is great because you can make money anywhere and it's, small, portable. You want somewhere where you can view charts, like some type of streaming platform. And you also want a computer. I like actually charting on a computer better than charting on my phone. But you could develop whatever strategy you would like on your own. If you don't have a phone, I mean a computer, you could still chart on your phone. It just may not be as clear as charting on or as easy as charting on a computer. So next we're going to discuss different types of charts as well as learning how to draw your support and resistance lines. The charts that we're going to go over are line charts and candlestick charts. There's a lot of other types of charts out here, but these are the ones that we're going to focus on in the training. So a line chart is the simplest way it's like the simplest way to track the stock's price over time. And each given point on a line chart represents the closing of a period. And when it's all connected, it forms a trend. So line charts help traders spot trends easily, whether the stock is moving up, down, or sideways. That's the main reason you want to use a line chart, because you can sit back and see, okay, it's trending up, it's trending down, or it's trending sideways. Next, we have a candlestick chart. Now, a candlestick chart shows the price within a specific time frame, and each candlestick has a wick and a body. So this is your wick. These are your wicks, and then this area right here is your body. The body shows the open. The body shows the open and close for the day, where the wicks show the high and the low for the day. So a bullish candlestick essentially means that the price open here, we're just going to say $100 to keep things simple. Stock price opened at $100. It closed at $101. So the stock price went up that day. At one point, the stock may have traded at $99. And at another point, the stock may have traded at $102, right? That's what this means. Just keeping it simple with the numbers. The Yeah, we're just keeping it simple with the numbers. So this is a bullish candlestick if the price goes up that day and it opens lower than it closed. Next, we have a bearish candlestick. So with the bearish candlestick, it essentially means that the price opened higher than it closed. So the price opened here. We're going to use the same example at 101. And by the time it closed at 100. At some point throughout the day, it went to that 99. And at some point throughout the day, it went to 102, but it closed here at this $100. And that is a bearish candlestick. So you'll see the bearish candlesticks represented in like filled in. You see how this is black, or some charts it will be green or red. So not green, a bearish candlestick will be red if the chart is green and red, and it will be black if the chart is black and white. And where in a bullish candlestick will be green or white or like open. Now you can't have any training without homework. Your homework is to start building your watch list. Your watch list is just different charts that you watch, keep an eye on that you may or that you may want to trade someday. So yeah, just start building your watch list. This is just some examples of some of the stocks that I have traded in the past year. Feel free to add them all to your watch list, or you can add whatever stocks of your choice. But just start creating your watch list. Next, we're going to talk about chart patterns and candlestick patterns. So chart patterns are the pictures we see, and it helps us determine how we're going to trade, where candlestick patterns are possible signs of a reversal or a continuation. Now, here's an example of a few candlestick patterns that are one-day reversal patterns. And one of the key one-day reversal patterns is a doji. And the significance of the doji is that the price opened and closed near the same price. So remember the example I gave you earlier. Now the doji, it may open at 100, go up to 102, come down to 99, and still close at 100. So that's what that means. And the same thing with the star body. It's like the size of the body does not exceed the size of the wicks. Um, And again, this is a one-day reversal pattern. So when you see these near your support and resistance lines, that means 9 times out of 10, the stock is going to reverse. I'm going to say 8 times out of 10, the stock is going to reverse the next day. And especially if it appears after a strong trend. So next, we're going to talk about the hammer. Now, I know you see all of these names up here on the screen, but before we get caught up on the names, the main thing to notice with the hammer is that it has a small body and a long lower wick. So the long lower wick indicates that buyers are stepping in and the stock price may stop falling. So in this example, you know, it opened here. At some point, it went down here, and the buyers was like, mm-mm, brought the stock price right back up. At some point, it may have came here. The sellers may have took their profits, and boom, then it closed here. That's kind of like an example of like how you would read that this reversal pattern. Again, you don't necessarily have to remember the names, but remember what it looks like. You can just remember the hammer because it looks like a hammer. And you want to make sure they're at key points as well by your support and resistance lines. So next we're going to talk about the double top and double bottom. And they're powerful reversal signals that signal a potential trend change. So a double top looks like an M, and it's where the price hits resistance. It's where the price hits the resistance line twice, but it fails to break through. So that signals weakness. And next you have the double bottom. The double bottom looks like a W. And again, this uses the support line where it bounces off the support line twice and it tests the support line twice before bouncing back, hitting a possible uptrend. The key with the double top and the double bottom is you want to your entry price is going to be when the stock falls below that neckline. So your entry will be right here once that stock falls below the neckline, and you're going to continue to ride it down. And the same thing with this, you want to make sure it bounces off of that support at least twice. Once the price passes this neckline, this is your entry point, and you ride it up. Write this down. Draw your double tops and double bottoms. If you need to pause the video right now, pause the video, draw your double top and double bottom, draw your neckline, draw where your entry points are. Next, we're going to talk about head and shoulders. And it looks very similar to the double top and double bottom. The significance with the head and shoulders top, it has the one peak with two smaller peaks next to it. So you'll see like it looks very similar, but this also indicates a trend change. So let's just say the stock has been bullish and going up. When you start seeing this, it hit resistance, come back down, exit. Well, never mind. This is if you're already in the trade. That's what I say exit, but no. This is your entry point right here. Because again, you want to make sure it falls below that neckline. Once you start, if you are in a trade though, and you start seeing something like this, exit, go ahead and exit your trade before the trend reverse. And then you can buy your put and ride. You could play both sides on this. But for right now, we're just gonna focus on the head and shoulders. Now with the head and shoulders bottom, it's gonna use your support line. And again, you want to make sure the stock falls below that neckline. And then this is going to be your entry point. Next, we're going to talk about a cup and handle. The cup and handle is a bullish continuation pattern that signals a potential breakout. And it looks just like it sounds. You have a cup-shaped curve followed by a dip or the handle. The cup forms when the price recovers from a decline. So you see a decline here. And then buyers gradually step in, taking control. Buyers are gradually stepping in, taking control. And then once it hits resistance, it may consolidate for a couple days and pull back a little before breaking out. And once it break out of that handle, it typically indicates a strong upward movement. Now, this is something that I recently discovered and I recently started doing. Is I would go to ChatGPT. I'm pretty sure you have heard of it. If you have not, look it up. But ChatGPT, ask ChatGPT, provide me with a list of stocks that are currently trading in a cup and handle pattern. And ChatGPT will provide you with that list. Again, you do your own research. Do not blindly invest in anything. I'm just giving you a little tip if you're struggling to find the cup and handle pattern. Keep that in mind. And you can probably do that for any other pattern as well. Now it's multiple patterns out here. These are the ones that I use over and over. I keep them simple. I don't do too much. Next, we're going to talk about a channeling stock. A channeling stock is essentially a stock that is moving in a predictable and repeatable pattern over a certain period of time. Channeling stocks can move in three directions. It can move up, down, or sideways. So when you have a channeling stock, basically traders use channeling stocks to time their entry and exit points. So when you draw your support and resistance lines and you notice the stock is channeling, you want to at least make sure it has like bounced off of support at least twice, as well as resistance. And then that kind of like confirms that when it bounced off that support line that second time, that will like confirm that it's actually channeling. And so the way you would use it is you would have your entry point just above support, and your exit point is going to be just below resistance. You're going to set your stop loss below, just below support, just to give it a little cushion, just in case it comes like under the support line a little bit. You don't want to prematurely get like exit the trade. So when you see a stock that is channeling, make sure you draw your support and resistance lines. Write this down. When you see a stock is channeling, make sure it hits the point at least twice. Make sure it hits the support and resistance at least twice before you get that confirmation. Once it bounces back off of support, your entry point is going to be just above support. You're going to ride it until just below resistance and you're going to sell. We're going to set our stop losses. That way, just in case the stock like it goes against you, we didn't make the right decision, we have our stop loss, we're not losing too much money. Okay? So make sure you write this down. Now, this is what I mean by it could be trading up, down, or sideways. So it could be in an upward trend. And again, like when you draw your support and resistance lines, you're going to use these opportunities near support as entry points, and just before resistance, your exits. And you can also play both sides. And I'm going to teach you that with the options by buying puts. And you can play on the downfall, and you can also make money while the stock is going down. But you also want to, if you choose to play the put, your entry would be just below resistance. and your exit will be just below support or just above support. Same thing with the downtrend or a bearish trend. You just want to look for those opportunities while the stock is channeling between those prices. Now, eventually the channel stocks, they're gonna break out of that trend. So when you have your support and resistance lines drawn, you'll see, once those peaks start, once it breaks through resistance, the resistance lines, 9 times out of 10, that's the end of that trend, and it's a strong, like it may be a strong rally. And the same thing with the when the stock goes down, if it breaks below that support line, it also may indicate like a strong price drop. Well, it will be like a bigger drop than what it was already experiencing. All right, so these are our rules for channeling stocks. Now, you want to make sure the price is below $15. Now, this is for stocks and not options, okay? You want to make sure it has channeled once or twice already. You want the stock moving up off of, well, we're talking about stocks. You want to make sure it's moving off of support. Make sure you chart your support and resistance lines, set your good to sell order, and or your good to cancel sell order or your stop loss, and then wait for your trade to complete and do it all over again. Next, we're going to talk about margin. Basically, a margin allows a trader to borrow money from their broker to trade larger positions. So let's say you put $5,000 into your account. Your broker may allow you to trade with $10,000, essentially doubling your buying power. You want to be careful when trading on a margin account because just like your money is magnified, the losses can be magnified too. So let's just say a trade goes against you, you may be left owing more than what you actually paid for the trade. So I would just say be careful when trading on margin. So that was like basically the end of the stock market portion of the training. I hope you guys learned something. And now we're going to get into options. So with options, you also have your bid by ask price and your spread. But you will notice with options, the spread is wider than it is with stocks. And you can typically negotiate 1/3 of the spread price. So you could maybe say like, hey, I'm gonna put a limit order in for 245 and you get this contract for 245 when or even 235, just something like that, when right now the asking price is 255. Now, with options trading, it essentially comes down to two different types of contracts, calls and puts. Calls give you the right, but not the obligation to buy the stock at a set price before expiration, while a put gives you the right to sell. Traders buy calls when they expect the stock to go up, and if the stock rises above the strike price, they can make a profit. Now, puts work the opposite way. If you expect the stock price to drop, you want to buy a put. And if the stock falls below that strike price, the put gains value. So calls profit off of upside moves, where puts profit off of the downside moves. Master these, and you can master the market. Okay, so I just mentioned strike prices. The strike prices are basically increments that set the dollar difference between the available option strike prices. And these increments can vary depending on the price stock and liquidity. So for instance, for lower price stocks, you may find an increment that's like 50 cents. So if the stock is trading like $5, $7, something like that, you'll see 50-cent strike price increments, where if you have higher price stocks, then you'll see like $2.50 increments or like $5 increments. Now, with options, with each option contract, you own or control, you control, you don't own, you control 100 shares of stock. And